If you're looking to invest in rental property in Dubai, this video will tell you in detail how much money you can make. I'll show you how to quickly assess any property on a napkin, and then I'll walk you through advanced techniques that determine whether the investment is worth it. Because after helping lots of investors, we've noticed that many have a completely wrong idea of which units are the best for renting out and how much money you can really make. So now we'll clear things up once and for all, starting with a quick and dirty analysis. You can do it on any scrap of paper you have, and actually that's exactly what I will do. It's really easy. So let's say it's 2021 and we're considering 3 different projects to buy a property for rental income. I've intentionally chosen 3 very different options for this exercise so we can see the range of outcomes. Project number 1 is Bengati Gate. It's a 9-story residential building in GVC, and here we're looking at a 780 square feet 1-bedroom priced at $145,000 US. Project number 2 is Burj Crown by Emaar. It's a 44-story building in downtown, just 10 minutes walking distance from Burj Khalifa. In this project, we're thinking about buying a 2-bedroom apartment of around 1,000 square feet, priced at $583,000 US. And the third project is a villa in Dubai Hills. It's a 4-bedroom villa in the Gulf Grove sub-community, 3,800 square feet, priced at around $1 million US. Now, let's do a quick analysis. The first thing is to take the average rent of similar units in the same areas. In 2021, 1-beds in GVC were rented out for $10.4 thousand per year. 2-beds near Burj Khalifa in downtown were rented out for around $30,000 per year, and the 4-bed villas of a similar size in Dubai Hills were rented out for $38.2 thousand US. Now let's do a super simple thing. Calculate the rent-to-price ratio. It's an indicative metric that lets us quickly compare different properties. The average in Dubai is around 4–5%, so anything higher is good and anything lower is not really great for rental income. Well, for Bengati Gate, the rent-to-price ratio should be around 7.2%. Not bad. Burj Crown is at 5.1%, close to the market average, so it seems alright. And the villa in Dubai Hills would potentially have a 3.8% rent-to-price ratio, which is quite low. All these numbers are just about rent, and of course, don't reflect value appreciation potential. To fully assess the rental economics, we need to calculate the total acquisition costs. There is a 4% Dubai land department fee, plus up to $2,000 in administrative fees. So Bengati Gate costs around about $153,000 US, Burj Crown about $608,000, and the villa in Dubai Hills around $1,042,000 US. The next big chunk of costs are operating expenses that you, as an owner, will have to pay regularly. These include service charges, maintenance costs, management fees, housing fees, and utilities. Service charges vary from project to project. For Bengati Gate, it's just $3 per square foot, so about $2,300 total. Downtown is more expensive, and for Burj Crown it's $4.5 per square foot, about $4.5 thousand in total. Villas usually have lower service charges. In our villa case, it's about $1 per square foot, so $3.8 thousand total. Then maintenance. It's basically zero for Bengati and zero for Burj Crown, because in residential buildings, most general maintenance is covered by service charges, and inside the apartment, the tenant is responsible. Villas are a bit different, and as an owner you'll have to pay for maintenance. Overall, with this villa, we can expect spending around $5,000 a year. Management fees for long-term rentals are covered by the tenant, so for you it's zero. The same goes for housing fees and utilities. So the total annual operating expenses come to about $2.3 thousand for Bengati Gate and $4.5 thousand for Burj Crown. For the villa in Dubai Hills, it's $8.8 thousand. When we sum everything up, we have the following estimates. A 1-bedroom in Bengati Gate should bring a net rental income of about $8,000 US, giving a 5.3% yield. A 2-bedroom in Burj Crown should bring $25.5 thousand per year, which is 4.2%. That's lower than Bengati Gate. And the villa in Dubai Hills is the worst, $29.4 thousand in net rental income per year, which is just a 2.8% yield. So it looks like from a rental perspective, a villa doesn't make any sense. Downtown is better, and GVC is the best, right? Actually wrong. In reality, everything ended up very differently. By the end of 2024, 4 years later, a one-bed in Bengati Gate brought its owner a total of $32,500 in net returns. That's 21% rental income on invested cash. Bush Crown brought its owner just $39,000, which is not much for a $600,000 investment. That's only 6.5% cash-on-cash returns. And the villa in Dubai Hills got its owner $218,000, which is also a 21% cash-on-cash return, same as the Bengati project. And that doesn't include value growth. If we add that, the owner made over $1 million net. But how did Bush Crown end up bringing less income than Bengati Gate, which is 4 times cheaper? And how did Dubai Hills, which initially looked like the worst, got so much money to the investor? To answer this, we need to put aside the quick and dirty analysis and talk about more advanced things. First, speed of construction. It has a huge influence on how fast you start making money. And that's the main difference between the winners and the loser. Bengati is known for delivering buildings fast. They are vertically integrated and keep all operations in-house, which lets them build faster than the competitors. Also, sometimes they start selling when the part of the building is already complete. In this project, Bengati Gate investors rented out apartments in just 1 year after the sales launch. That's extremely fast. So they were making money for 3 years out of 4. Meanwhile, Bush Crown investors had to wait 3 years for the building to be delivered. The villa in Dubai Hills was delivered in about 1.5 years, because villas are usually built faster. And in this particular case, due to the post-pandemic downturn, the units weren't sold out that quickly. But that's not all. The next factor really made the whole case for Dubai Hills: high demand developing areas. When an area is developing, the rent goes up. New roads, shopping malls, parks, schools, and less construction all make the area more attractive to residents. And in this case, it's not just any area. It's a uniquely green neighborhood with a big park. In Dubai, such neighborhoods are in extremely high demand among families. And what else is in demand among families? Villas. The more families relocate to Dubai while supply is still low, the more you can charge. So this unit was a jackpot. Look at this graph showing the average rent of 4-bed villas in Dubai Hills. The rental prices there skyrocketed. So estimating area development potential based on demand is a must. But even in a bad area, you can find great rental properties, because quality matters. Here's one example: Al Furjan. This neighborhood isn't much to look at, either for living or investing. It's located somewhere between the Palm Jumeirah and Jebel Ali, far from the sea and key city spots. Maybe the main plus is that it has a metro station. A typical one-bedroom apartment there rents out for around 60,000 dirhams or $16,000. But not long ago, a project called Westwood was built by a relatively new developer, Imtiaz. One beds in this project rent for an average of 95,000 dirhams or $26,000. This huge difference is because Imtiaz builds with exceptionally high quality, especially compared to the existing developments in Al Furjan. Plus, the apartments come fully designed and furnished. That's a super obvious example, but of course, the developer you buy from and the overall project quality can make or break your investment. But sometimes, quality isn't that important. What if I told you that there is no point in buying from fancy developers sometimes? Weird, right? But that can be the case with Airbnb Rentals. For many tourists coming to Dubai for a short stay, construction quality isn't the priority. Views and location matter more. Visitors normally look for properties in tourist areas like Marina, the Palm, downtown, or Blue Waters. Or, on the contrary, somewhere near the key commercial centers. That's why apartments in Shoba Heartland can have high occupancy rates. It's pretty close to downtown. One thing to note is the competition with hotels. That's why studios, for example in Marina, aren't always great for Airbnb. They compete with budget-friendly hotel rooms. Bigger properties, on the other hand, are more competitive. They are popular with families visiting Dubai and often more affordable than big or multiple hotel rooms. Renting out on Airbnb also changes your cost structure. First, you'll need to furnish the place. For a small low-budget setup, you might spend around $5,000. For bigger or more premium properties, that could go up to $10,000–$20,000 or more. Second, you'll have higher operational expenses. Now you're the one paying for utilities, housing fees, internet, and cleaning. Plus, you'll need a management company that takes a share of the revenue. Still, your revenue can be higher. When renting out short-term, you can use dynamic pricing, meaning you adjust rates based on demand. Your occupancy rate may be lower, but good properties can reach 80–85% utilization. As a result, you can make 20–25% more net profit than if you rented the same property long-term. The main downside of renting out on Airbnb is that it's not stable, especially in crisis periods. So let's talk a little about stability. Look at these two graphs showing the average rent for two different types of units in Dubai Marina. Pay attention to 2020 and 2021, the years of the global pandemic. It's the same area, but the average rental rates for the first type declined drastically, while the second type stayed absolutely fine. Before I tell you why, you should understand that tenants aren't all the same. Some are willing to pay a premium, some are more stable than others. And to address the specific needs of these groups, you need different units. The most stable type of tenant is usually a family of residents. They have more considerations, and they're more selective about what exactly they want to rent. But once they choose, they're less likely to move. So families need bigger units. The first graph I showed you was about one-bedroom apartments, and the second one showed the rental rates for three-bedroom apartments in Dubai Marina. But there is the other side of the coin. Bigger properties usually have a worse rent-to-price ratio. For example, over the last 3 months, the average rent-to-price ratio in Dubai Marina was around 7% for one-bedrooms, while it was 6% for three-bedrooms. So you choose between higher returns or better stability. And it's not just about the number of bedrooms. Villas are more stable than apartments, and residential areas are more stable than tourist hotspots. Now that we've discussed stability, let's move to the final point. This is something that hugely affects the economics of the investment, but it's not obvious to many people. Payment plan. See, your payment plan isn't just about the convenience of paying a certain sum. It directly determines how much money you make. Let's say you're buying a $1 million apartment and pay the full sum in cash upfront. I'm intentionally making it a radical example to prove the point. Your acquisition costs will be the price, the DLD fee, and the admin fees. $1,042,000 total. Then the building is under construction, and in the first 3 years you get no rental income. In year 4, you rent it out and get $100,000 in income after service charges. That's your net rental income. So 5 years after the purchase, you've made $200,000 in total rental income. If you divide that by the amount you invested, you get 19% cash-on-cash returns, not including property value appreciation. Now let's compare this to a flexible payment plan. Let's say it's 50-50. So the first 50% is spread over the construction period, and 30% are paid during the first year. This makes your initial investment $342,000. Then in year 2, you pay another $100,000, and in year 3, another $100,000. In year 4, after the handover, you pay the remaining $500,000. The total acquisition cost is still $1,042,000, and the rental income is still $200,000 over 2 years. However, you didn't invest the whole sum upfront, so you could put the rest of your money into something else. A savings account, the stock market, crypto, or anything you think is best. And because this money was working, those profits should be counted too. Let's assume you decided not to take big risks and earned 5% interest on your money. Over 3 years, you'd make an additional $90,000. This makes your total 5-year return $290,000. Your cash-on-cash returns grow to 28%, compared to 19% in the first case. That's a huge difference. And all these points were just about rent. If you want to learn how to make a full assessment of the property investment in Dubai, check out this video.